Welcome back to Iraqi Dinar Hub. The global currency revaluation arena is taking a new turn as the Zimbabwean dollar ZWL gains traction in a market still reverberating from the recent dramatic revaluations of the Iraqi tree, Dinar, USD, and Vietnamese Dong VND. Although the ZWL has not seen an explosive spike in today's trading, investors are starting to consider it a serious watchlist currency among the basket of suppressed or undervalued assets. Zimbabwe's economic journey, long troubled, is now marked by cautious optimism as it embarks on substantive monetary reforms aimed at long-term stabilization. Key reforms are already underway. Zimbabwe's central bank has initiated policies that include the formation of a gold-backed monetary system, improved fiscal controls, public audit mechanisms, and deeper alignment with the BRICS bloc. These are not perceived as catalysts for immediate speculative growth, but are instead seen as foundational changes aimed at restoring financial credibility. Many note that Iraq and Vietnam implemented similar reforms before their currencies moved upward, indicating that Zimbabwe may be on a similar path toward eventual currency reform backed by tangible assets. For the first time in years, analysts are speaking of the ZWL not just in terms of controlling inflation, but as part of a bigger strategy of global repositioning. The long-term thesis emerging is that Zimbabwe's slow but steady policy evolution may culminate in a significant revaluation. While not expected to mirror the speed or publicity of the IQD or VND, the ZWL's gradual reform arc is increasingly viewed as a strategic opportunity for investors willing to take the long view and ride the transformation patiently. Despite this, skepticism runs deep. Zimbabwe's infamous 2008 hyperinflation disaster still weighs heavily on investor sentiment. Unlike Iraq or Vietnam, whose currencies were suppressed yet never entirely discredited, Zimbabwe must overcome a deeper trust deficit. Rebuilding confidence requires more than signaling reform. It demands consistent, transparent implementation. Still, for investors who specialize in long-shot recoveries or asset-backed opportunities, Zimbabwe is beginning to check off several crucial boxes. Momentum is building around the country's resource base. Zimbabwe is formalizing new export agreements in gold, lithium, and agriculture sectors capable of anchoring the ZWL's value. Just as Iraq leverages oil and Vietnam leans on manufacturing, Zimbabwe's commodity output could serve as a real backing for its currency. Its growing association with resource-rich alliances like BRICS adds a further layer of geopolitical stability, enhancing its potential credibility on the global monetary stage. This evolving view is attracting a new kind of investor, those not interested in quick speculative flips, but in strategic positioning ahead of dawn. Systemic financial reform. Many are now treating Zimbabwean notes as hedging instruments in a broader realignment narrative, one that prioritizes currencies grounded in real assets and sovereign production. The narrative is slowly shifting from risk avoidance to calculated opportunity in a rapidly changing monetary landscape. From a technical standpoint, seasoned analysts are pointing to fascinating chart developments in the IQD and VND. The Iraqi Dinar, stagnant since 2003, has broken out above a 10-year downtrend line dating to 2012. This breakout was validated by strong technical signals. The RSI moved into bullish territory, and a weekly MACD crossover was confirmed, reflecting structural buying momentum. Volume indicators have also surged, supporting the belief that this isn't a fluke but a turning point. Similarly, the Vietnamese Dong has climbed past the psychological barrier of 0.043 USD, a level that had resisted upward movement for years. Technical models such as Fibonacci projections now forecast a potential move toward the 0.058 resistance range provided volume holds. This breakout has drawn comparisons to historical currency realignments, like the Deutsche Mark post-reunification and the Kuwaiti dinar post-Gulf War. Analysts believe this may mark the start of a broader macro revaluation of non-G7 currencies. What really confirmed this trend wasn't a price chart or a trader's tweet, it was the reaction from America's banking giants. As the IQD and VND surged, major banks like JP Morgan Chase, Bank of America, Wells Fargo, and Citibank reportedly launched internal reviews and compliance updates to reevaluate how they handle foreign currency, particularly exotic notes. These institutions are now actively reassessing reduction policies, liquidity risk, and foreign exchange frameworks. For years, US banks largely avoided engagement with currencies like the IQD and VND, labeling them too risky or obscure. But the velocity and volume of recent trading appear to have forced a shift. Insider reports say compliance divisions are now analyzing exposure models and adjusting internal systems, possibly in coordination with global banking networks. This isn't just operational housekeeping, it signals a mental pivot from skepticism to strategic preparation. In fact, this could mark the first major institutional shift toward legitimacy for these currencies in over a decade. Major U.S. financial institutions are beginning to treat IQD and VND not as speculative novelties, but as potentially exchangeable assets requiring serious infrastructure. This development could lead to wider adoption, particularly if sustained activity is met with clear central bank policies and stable liquidity patterns moving forward. Meanwhile, retail customers are getting mixed signals. As the financial ecosystem scrambles to catch up, ordinary clients are being met with confusion. Some bank staff deny knowledge of the dinar or dong, others redirect inquiries to foreign exchange departments. This inconsistency is frustrating for everyday holders, but is starkly different from the approach being taken behind the scenes with institutional clients and high-net-worth individuals. Private banking DAO. Clients, particularly in wealth management divisions, are receiving discreet briefings. Relationship managers are quietly reaching out to discuss documentation, appointment scheduling, and redemption planning. This two-tiered approach, one public-facing and confused, the other institutional and deliberate, shows the divide between visible policy and backstage preparation. The growing number of strategic conversations with elite clients suggests this is more than a passing event. Retail infrastructure is still lagging. Bank systems, employee training, and public policies haven't caught up at the pace of developments. But with several financial giants now moving toward readiness, public-facing changes may soon follow. If coordination with central banks like Iraq's or Vietnam's materializes, it could accelerate formal policy announcements, solidifying these currencies' positions as legitimate instruments of trade. All signs currently point toward momentum. As excitement builds, both retail and institutional players are preparing for heightened volatility. Projections for the short term are varied. Some expect minor corrections, others anticipate further surges. What's nearly certain is that price swings will continue as institutional systems and market infrastructure race to adapt. The volatility, though potentially unnerving, may offer tactical opportunities for those paying attention. Pullbacks are likely as early investors lock profits and algorithmic trading adjusts. But these dips are widely viewed as re-entry points, not as a signal that the rally has peaked. This breakout is different from past rumor-fueled frenzies backed by liquidity, technical confirmation, and a growing institutional presence. The shift underway appears to be part of a sustained structural transformation, not a passing phase. A particularly interesting trend involves contract rate conversations among wealthy investors. Reports suggest that certain banks and wealth managers are exploring limited-time rate locks for select clients. If this proves true, it would imply a deliberate effort to control the redemption process, managing both demand surges and systemic exposure. Such measures could help avoid panic-driven activity while preserving liquidity and order. Alongside these discussions, central bank announcements remain a key catalyst. Any official move, whether an adjustment in foreign exchange rates, the lifting of currency pegs, or other structural realignments, would likely trigger further upward moves. The market is watching closely. As banks prepare and central authorities weigh in, we may be witnessing the start of a historic revaluation cycle, not just for IQD and VND, but for emerging currencies globally. Thanks for tuning in to Iraqi Dinar Hub, your trusted source for real-time updates, deep analysis, and strategic insights into the world of currency revaluation. If you found today's breakdown valuable, don't forget to like, share, and subscribe to stay ahead of the curve. As the global financial landscape continues to shift, we'll be right here bringing you the facts, the signals, and the moves that matter. Until next time, stay informed, stay prepared, and keep your eyes on the horizon, because history may just be unfolding right before us.